And good afternoon. Welcome into a Wednesday, January 6th, 2021 edition of Market Talk. I'm your host, Jesse Allen. Great to have you here with us. Happy New Year. And thank you for joining us once again for another edition of the program here today. Hard to believe still. I can't wrap my head around the fact we're in 2021. MarketTalkAg.com. That's where you can find us on the World Wide Web. You can find us Facebook, Twitter, Instagram, all at Market Talk Ag as well. You can find the links to listen to the podcast, listen to shows, archived episodes on your favorite streaming source, all on our website, MarketTalkAg.com, or via many of our great radio affiliates. You can find a list of them as well on our website. Got a lot to talk about. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk. And Mike, Happy New Year. Good to hear from you and good to see you, my friend.
You too, Jesse. Nice to be back with you.
Now, we got a lot to talk about since the last time you and I chatted, Mike. Just thinking, a couple weeks ago is when we were talking and we were looking, what's this market going to look like moving through the holidays? Well, we've seen pretty much a rocket ship strapped to the back of some of these grain markets. I just want to get your overall reaction to what we've seen the last 2 weeks or so in this grain market and just some of your thoughts on it.
Yeah, I mean, obviously, to start off with, I don't know where we left it off as far as price objectives last time we spoke, but I was surprised to see both Thanksgiving and Christmas give us such a surge without much of a correction other than like an intraday correction of about 40 cents in between Christmas and the New Year. And I think that speaks a lot to, it's not just about the weather, and it's a lot about the macro. It's a lot about the currencies. It's a lot about new 12-year highs in the Chinese stock market and new multi-year highs in their currency. It's a lot about the Argentine port strike. There were a lot of features that have come in along with the weather that have kept the bull running very hard. So getting above 1260 to 1280 was a surprise to me before the January crop report. And in fact, the way we've done it, Jesse, by going what I term as parabolic, which is a near straight up move to the upside, this is a supply-led demand rationing market on the likes of 2007, 2008, and 2012. Heading into this January report, I am very concerned that we are rationing demand too much and that we will have a pullback after the report or right before the report. What I'm preparing my clients for is pretty simple. In both 07 and 08 and 2012, in 2007, for instance, we went from about 840 in August of 2007. We went 13 months higher and doubled our price essentially to 1660. But within 3 months, we were back down. By August of 2008, we had hit that 1660 level. By the October, or excuse me, maybe July of 2008, by October of 2008, we had taken away 75% of that rally. We were back. In fact, by the time we got to the lows of October 2008, we were back to 8.25. We had erased all the gains in 25% of the time period of the rally. So 2012 was a similar pattern. It takes many months to build the base and then shoot up sharply, but it takes hardly any time at all to break the market back down. So I'm really trying to prepare the clients and subscribers right now for a similar pattern. I'm not saying right after the January report everything's over with. What I'm saying is a correction is needed here to encourage demand to not run like it's probably running right now.
Well, and let's break this down a little bit and talk specifically with the different commodities. And you mentioned that correction. I want to start with corn because I think there's a lot more producers that have corn in the bin right now, and they're looking to maybe make some moves here. We're pushing $5 corn, Mike. But right now, excuse me, looking at this corn market, we wonder where does this go? Can we break through $5? Will we see some selling at that point? And then you mentioned, of course, the January report coming up here less than a week away. How much is that going to affect this corn market? How big of a correction do you think we could see in this corn market?
Yeah, I think there's less of a corrective wave in the corn market coming simply because the wheat has not built too much of a premium. Now, granted, I did make some more wheat hedges for 2021 earlier this week when we hit my overvalue level on lead month futures of 665 area, and that took us up to about 645 in lead month soft red wheat. But the wheat has not been acting like the corn or like the soybeans, especially. I think this is your question really has an unbelievable prescient issue to it, Jesse, in my opinion, because if we really dial it all the way back to the beginning and say what started this rally, it really was China. It was China before the South American weather. And when you look at futures prices right now in the Dalian exchange in China versus the mercantile exchange here in the United States, it says a lot, I think, to how much of a correction corn could have versus beans and how much further upside corn may have to be able to force more acres into corn. I'll give you numbers. Meal in China right now at the Dalian exchange is just under $490 a ton. That's US dollars. We're trading 442. So about $50 a ton cheaper at this point in the United States. Not a lot. Beans, even less so, $550 a ton roughly, compared to about $540 a ton here in the United States. So not a lot of difference there, not nearly as much as there was 6 months ago, or especially 3 months ago. Corn, however, the Dalian exchange is running $420 a ton. That's almost a $10.70 a bushel price at that futures market. This compares to our price of about $195 a ton at the mercantile exchange. So if I just use that one metric, it screams to me that we are rationing demand in soybeans. China's not getting a big bargain by buying U.S. beans, but they're getting an unbelievable bargain, especially if Argentina doesn't have corn, by continuing to buy U.S. corn. So again, like we've talked about before, if I'm buying back anything right away at these price levels, it is going to be corn, much more so than beans, especially going into the January crop report.
Well, and you think about corn as well, and we talk about the weather issues in South America and those metrics that you shared. Great stuff there, Mike. It really kind of puts it in perspective. And we think about corn, you know, we're sitting close to $5 corn, and I think a lot of people are wondering, $6 corn, is that possible? But you know, like I've mentioned as well, we think about it, there's a lot more corn out there in the countryside than beans. So it seems like there's going to be more opportunity, by the way it sounds, to take some profit in corn right now.
Yeah, this is where the defense comes into play. I mean, no one knows what the weather is going to be. No one knows what the results of this Georgia runoff will be, and what's going to be the extent of the potential new regulations and the potential for higher taxes. We just don't know what a new Biden administration will do when it comes to relating to the commodity markets. And so to me, it's almost like you are walking away from a great big pot of gold just because your ego needs to be fed. And I'm being very blunt here. I mean, it goes back to, why do I go back and look at price rallies from 2007, 2008, and 2012? How does it happen that it takes so long to go up and it's so quick that it's all over with? It's what we're talking about right now, where we can't see any lower prices. We just want to hold on. And I joked with the client, but it wasn't a joke. It was really a sincere point. And he just laughed and laughed at me because I said, "Are you going to let go of some old crop corn here and buy some calls with me?" He goes, "I'm waiting for $5 even." I said, "That's fine. But you know, Jim, when it gets to $5 even, you'll raise it to $5.50. And he just started laughing because that's exactly what we do. We've been taken to the cleaners the last 5 years by low prices, and we want to make that back. Nothing wrong with that, but just realize you can't get from point A to point B without putting too much risk on your operations bottom line. That's really what we're talking about at this stage of the game. I really don't care how high soybeans go at this stage, Jesse, because I know I'm profitable for the clients that I'm selling this market into at this stage. And I'm so glad that I'm starting off at 1070 or 1050 new crop beans instead of 850 or 950 new crop beans. We really got to go back to that, I think, and address what the not very long ago distant past showed us as far as how bad can be.
Well, and I love how you brought up that point about, you know, hey, get to $5 and then, oh, well, I'll get to $5.50, because it is very true. It happens time and time again where people maybe they I don't want to say get greedy, but they they're sitting there, and the ego gets a little bigger. They're thinking, oh, I can run this up a little bit. But at the end of the day, at price levels like this and the profit that's on the table, you got to be smart about things.
You do. And I think at the end of the day too, we have to be in grains. This is where I actually enjoy livestock analysis more than I do grain analysis, because we can't put pigs in a bin. We can't put cattle in a bin. We got to market. And you know what? We got to be price takers when we're livestock marketers. And so if I have a ranch or a CAFO or something like that, I've got to learn to be a price taker, especially if I'm an independent still. And I think this is where you can learn a lot from a livestock person in the grain complex by being a similar to a livestock marketer, in that you always remember at the end of the day, when you put your pillow on the head, I'm a price taker because I produce the supply, and I can't ask the demand side to meet me where I need to be met each and every time I go out there and plant a new crop. And I think this is where the distinguishing between wheat, corn, and beans is going to be very valuable. We haven't talked a lot more about corn, but one thing I really wanted to bring up was we had talked about the fear of demand rationing when it came to ethanol, not just from a policy standpoint, but now we're breaking $5 corn, as you're saying. I'm seeing Northeast Iowa ethanol margins sink to a negative 30 cents. It makes sense because of where we're at in terms of unleaded gas prices, ethanol prices, DDG prices, and then the corn price. And I'm also hearing more and more from the Western Corn Belt producers, especially, that we're seeing some ethanol plants go shutter again. And I know there was the oldest plant in Greedion in Cedar Rapids, Iowa. I think they have decided to shut permanently, mainly because of higher corn prices. So we're rationing demand, and that's the bad side about these parabolic rallies. The demand can't seem to catch up, and your costs get out of whack, and you got to start slashing very, very quickly on the demand. And that historically, that's what happens.
Yeah, and that's something, a great point you brought up about that plant in Cedar Rapids shuttering here at the end of the month. At least the ethanol operations, I believe, from what I read. I think we're going to see a lot more of that the next couple of months here, regardless of where this market goes, just because, like you said, we kind of got to catch things back up and even them out.
Yeah, and the Department of Energy just came out with fresh information for 2020, and I think they were putting, they put the overall DDG production for 2020 down 4.5% versus 2019, and they put ethanol crush. This was USDA, excuse me. They put ethanol crush down 5.5%. Versus 2019. Department of Energy numbers from this week also suggested refining push the demand, the net demand from going ahead and refining in 2020 was down. Looks like it's going to be down with ethanol stocks down about 0.9%. All product demand for 2020 is going to be down about 12% year over year. This is where that COVID comes back into play for both livestock and the energies and eventually the grains. We can't get around the record number of hospitalizations. Maybe we're getting people out of the hospital faster, but the lockdowns are increasing because the hospitalizations are increasing. So the demand side of the equation is really, really tough. It's very opaque. It's like looking in a dark pond right now to understand how high are these prices going to get to ration demand, and how much are we rationing already? We just don't know. And the best guess we're going to get is from USDA in about 5 days.
I think you are very correct on that point. Soybeans, real quick, we didn't really touch on them a whole ton. I know we covered a little bit there. But, looking at beans, I know there's not a lot out in the countryside. What is out there, farmers are hanging on to it, and we're continuing to watch these prices push higher. But, the more I talk with folks, the more I talk, and hear from people, it almost seems like it's a matter of when, not if, the rally runs out in this bean market, we see a major correction.
Yeah, and this goes back to it's more of a function of time versus price at this stage, and I think that's where the January 12th report comes into real focus for me, because my price model would suggest at near $14 lead month futures, we are well below a 150 million bushel old crop carryover here in the United States. It's the South American number we can't get a real good beat on right now, and we need USDA's help with that. But having said that, in 2007, 2008, we had 8 straight months higher, and then we had a big correction month in month number 9, January is month number 9 on this rally currently, because we've had 8 straight months higher as well. This is the only time I can go back and find where we've had 8 straight months higher for the last 20 years, except for 2007, early 2008.
Well, let's switch over to livestock here, Mike. Let's talk cattle. I know on Wednesday, live cattle just eked out a few small gains, but really the market just was kind of light, kind of weak. Not a lot of activity in feedlot country. You know, we started the new year, the first trading session down sharply in cattle, got a lot of it back on Tuesday, and then we were just kind of mixed and blah today. What are you seeing with this volatility in the cattle market? What are some things we need to be looking for? Is there positives? Is there negatives? What are we looking at?
Well, the positive is the equities market. The equities market's dialed in a new all-time high again on Wednesday. That helps support the fat cattle. One of the other positives that I think is really important for the cattle rancher and the feeder especially is that the feeder fat spread's gotten down to about $20 premium to the feeders. You're talking about a multi-month low there. You can get down to around $14 or $15. And we did do that early in 2020 with that COVID shock that we had, where feeders just fell precipitously compared to the fats. But I think the feeders need to find a low first. It would make sense that they would find a low first, because why are they breaking to the fats so hard? Because of the corn feeder spread. The corn bulls are really working the long corn short feeder contracts right now, and you're seeing that in the feeder corn ratio being at right around a 5-year low, 4 or 5-year low right now. So I would say the fat cattle, Jesse, after the Fed cattle exchange didn't do any business on Wednesday, is probably a fair price with a premium in the futures. We can't do any better than 110 right now, it seems to me. And so we're going to have to rely upon the feeder contracts to make a low. Then I think the fat cattle have some upside. So what I'm telling clients right now in that kind of an environment is, with 119 April fats, get your hedges caught up, because this is a premium in this market going from February to April, and with January feeders trading right with the feeder index. I really like, with USDA's last second quarter price being a 113 level for fat cattle. We were at 124 last year at this time when it comes to fat cattle. So I really think at 119 April, you can't go wrong by putting a hedge in place. And then if you're paying the margin man, you're going over 120 in April fats, and you're 3 months out from actually marketing those fats, you're not going to be too unhappy with me by paying the margin man and marketing those fats at that price.
And that's some great insight. And, you know, I think it seems like there is a lot of opportunity in this cattle market if you're disciplined about it and get smart about it, kind of with everything. On the hog side, we got a little bit of pressure, it seems, around that $72 mark. And I know cash hog trade added a weaker undertone to this market, and we're just kind of fighting some resistance levels right now, it seems. What are you seeing in hogs right now that we need to pay attention to?
Well, they've picked up with the pork and bean trade again, which is real nice. The funds have come in and started to buy those hogs along with the soybeans, and that's gotten us to that 72 resistance. But you are right on the mark with that 72, 73 resistance being rock solid resistance. It's a brick wall right now. I see that continuing to be a brick wall in lead month until we get more towards the end of the month and the seasonals pick back up again. We're just kind of in a seasonal doldrum right now where we can't really find much in terms of featuring, and the pork seasonal for the holidays is well past now. And I think there's, you know, a tighter amount of cold storage supplies that will keep the market underpinned here. But I think if we really want to go above 72 and get rocking into that 75 plus level, we just have to wait till we get closer to February and get the seasonal on our side. And I hope by that time we also have the feeder cattle and the fat cattle markets back on our side at that point as well.
Well, Mike, as we head into this report, this January WASDE report, money, money, money. There's a lot of money throughout this market. Any final thoughts? Anything else you could think of you want to share or reiterate as we kind of lead up to that report?
I would only say get a trial on the website. It's in my caption there. Get a trial for what I do, because I think this is a really good time period to test out an analyst that does his own independent analysis. Because one thing I think that's been really consistent, Jesse, has been that dollar and that crude oil relationship we've talked about almost every week, and how it's been such a great canary in the coal mine for the commodity inflation bull. And I'm a little more than a little nervous that that commodity inflation bull has kind of overstepped his bounds. If we get a new administration, we see more regulations and we see higher taxes. And I think that if we go into more of a deflationary mindset and the inflation commodity bulls start to pull the plug, it'll happen first or be among the first areas in the crude oil and in the dollar. So that relationship's really paid off in spades for me analytically, and you can get more information and understand it better if you sign up for a trial.
Well, Mike, for those listening on the audio stream only, what is that website?
It's going to be globalcomresearch.com, and globalcom has 2 M's. So globalcom with 2 M's, research.com.
Very simple, very easy, globalcomresearch.com. Mike Zuzolo, appreciate the time. As always, we'll look forward to chatting with you next week after that report comes out.
Thanks, Jesse. Have a great week, sir.
Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk for Wednesday, January 6th. I'm your host, Jesse Allen. Have a great afternoon.